even around this whole Mag 7 debate, quite honestly, it's not like constant market concentration has happened before. It's not the first time. And even then, over time, passives have outperformed, right? And there's always, markets move in cycles. And so there will always be one sector that dominates. In this case, it's tech. Yes, you could argue that the dominance is quite big right now, which is why I sort of go back to my earlier answer that this is a healthy debate. But I do still think that passives are, personally, I would say passives are a better way to go given everything that we know today.
Hello, everybody. Welcome to the Mouthy Money podcast. I am joined, as ever, by my good co-host, Chris Chute, who is Head of Consumer Finance at communications agency MRM. Chris, hello. How are you doing?
Doing really well, Ed. How are you?
Very well, thank you. I think we've got a really interesting subject today. I know we've talked a lot around things like pensions, and we've begun to look a bit more broadly at some investment themes in recent weeks. So we're now going to take this a little bit further and look at some of the ideas around how you pick investments. Specifically, we're going to be looking at funds. Now, funds are obviously communal investment vehicles that the investment firms will manage on your behalf, and in a way that means you don't have to kind of pick individual stocks and shares and this sort of thing. So to do that, Chris, we've got a very, very interesting guest here today. So I'm going to introduce her before wasting any more time. That is Mohneet Dhir, who is co-founder of a financial planning firm called Antogether. Mohneet, welcome to the podcast.
Thank you, Ed. Happy to be here.
So Mohneet, the reason we've got you here is not just because you've just got started co-founding a brand new company, which we're going to ask you very shortly a little bit about, just to tell us about it, but your experience is actually in managing funds, and specifically you've managed funds in the past for Vanguard. Is that right? And tell us a little bit about it.
That's correct. So let me take you for a quick 360 of my career, because I think that will put things into context a little bit more. So I started off in the fund of hedge fund space. So I was a research analyst picking hedge funds that we think would outperform over the next 5-10 years. And so that was my first job. And then I moved on to Nomura Asset Management, which is a Japanese asset management house. I was managing fixed income portfolios there, so government bond portfolios, mostly for institutional investors. So think about it as big pension funds, monetary agencies, etc. Then from there, I moved to Vanguard, and I was there for the last 7 years before leaving very recently to start my own firm. But at Vanguard, I was covering multi-asset funds, life strategy funds, to be more specific, as a product manager. I'm so designing the funds, the governance, supervision of the funds, working closely with the analysts, portfolio managers, etc. So basically everything that's under the hood of life strategy, if you will. And now I've just left Vanguard to start Antogether.
Yeah. So like the life strategy funds are really interesting, I think, especially for investors who maybe want to be a little bit less in the day-to-day of what a portfolio might compose for them. So we're going to come on to them in a little bit, learn a little bit more from you, how you used to manage them and that kind of thing. Just tell us a bit about Antogether, though. What's the idea behind the new company and what you're doing?
Yeah, so Antogether is a financial planning firm. We're focused on entrepreneurs and founders. Antogether really came from our experience put together. So I started it with one of my ex-colleagues from Vanguard as well. And both of us, our experience together, we've worked with private banks, we've worked with institutional investors, we've worked with high net worth investors, basically all across the industry, really.
Yeah.
What's interesting is that we've seen what works and what really doesn't work, and what's just noise and marketing. The thing with the industry is that, there's a lot of products or funds and ETFs out there that are designed to benefit the manufacturer, not necessarily the end investor. And obviously, working inside the industry, you sort of understand how it all works, how products get designed. And, you've got firms like Vanguard, which are great, which are in it for the end client, or for the guy on the street, really, which is what you want. So that's great, but I wouldn't say every firm does it the same way. Vanguard's definitely one of the good ones, which is great. Now, Antogether came into being when, we were thinking about, what financial firm would we want for ourselves to manage our money, to manage our friends' money or our family's money. What kind of financial planning firm would we want, would we trust? And that's essentially where Antogether started. Our focus really is on fees being fair because one of the biggest problems with financial advice in the UK is that it's very expensive. And often that stops people from getting advice. So we want fees to be fair. We want investing and what we invest in to be honest, to be transparent, and simplicity, really. We're not trying to overcomplicate things. And
Yeah.
lastly, we just want to make sure that, we help entrepreneurs and founders throughout their journey. So it's a partnership. It's not just, you pick up the phone, you get one advisor today or another advisor tomorrow. You get the same person every single time. And so it's that partnership that we really value, and that we want to provide through Antogether.
So let's set a bit of context now for the chat today, looking at the issues we're going to go through. I think, and this is actually a report that just came out from the IMF, just with a bit of a warning, basically. It's something that I've seen talked about in the kind of financial services sector more and more, particularly financial planning space, are quite vocal about it. So what is the issue we're talking about here? When you look at things like passive investment funds, which essentially just track indices, be that the S&P 500, FTSE, all those kind of major stock markets around the world, particularly with regard to the US, we have an issue of essentially crowding and concentration. So if you look at the S&P 500, the IMF has just warned that the S&P 500, which is 500 of some of the biggest companies in the US, 35% of that is now weighted towards information technology sector. And about 7 stocks, so that includes big ones like Apple and Tesla, Meta, account for 33% of the whole index now, which is extraordinary. There's so much money in such a small, well, one bit of the market, basically. So this raises the issue of, well, if you're invested in a passive index, it might be passive, so it's just tracking what the market does, but the market might be doing something that is starting to look quite unhealthy. Chris, I'm going to bring you in at this point. Is this something that keeps you up at night? Because I know you've talked to me about things like the AI bubble and that sort of thing recently.
I wouldn't say it keeps me up at night. I'd say my 1-year-old does that. There are other things that so this is an age-old debate. You mentioned passives and actives. I think, well, you didn't mention actives, I don't think, but that is the corollary to this, which is passive funds, as you rightly say, sort of passively buy the amount of businesses that are within an index, right, and just follows their fortunes. And then the actives are actively managed by human beings who are looking to find the next trends, or hopefully are able to kind of avoid any major issues like a potential AI bubble or spot opportunities. What I've consistently seen in my 20 years in financial services comms is the media say that active versus passive over a long enough period of time, actually you're better off sticking your money in a passive because the charges are lower and actually the performance is comes out more or less the same. That is a sort of truism that I've seen enough times now to sort of internalize myself and go, right, well, that's how I'm going to approach this. I think, so what I've done is I bought a global tracker and then a load of trackers within each geographical region of the world, which is where I get my kind of diversification. I think I mentioned it on the last pod though. I have started to become a little bit concerned about this idea of concentration and the fact that there isn't somebody keeping an eye on this for me, and that, maybe it's something I need to look at. So I have, when I've been picking my passive funds, looked at what the funds are made up of and gone into the tool on Hargreaves, which shows you top 10 sectors, top 10 breakdown by geography, and top 10 breakdown by sort of companies, and have a limited knowledge of that and have seen enough there to keep me reassured up until now. The flip side of that is, well, okay, let's go active and find an active manager that you can trust and that you think is going to work or is going towards a sector that I think has got a potential upside. And some of the things Mohneet mentioned at the start about, those funds not necessarily being in it for me, rings true for me, or is an itch that I can't kind of shake off, if you know what I mean. And then you look at the charges for some of those and they are much higher, and you think, well, I'll go back to that truism of, well, are they going to be able to overperform it in the long term? There are certainly exceptions to that rule. So active managers who have gone on and done great things, I think, but I find picking them quite difficult. And so if I was to, I'd need to really think about who's involved and what's going on there. And while that doesn't keep me up at night, Ed, I do occasionally think about that in depth and see if I'm better off shifting, because I am concerned about concentration as an idea. What about you?
Yeah. Well, my own experience at the moment, I'm very much just exposed to the kind of global, I think it's like an MSCI global index tracker at the moment. And I am now feeling more aware, and that's in my main pension. My other pension, which we've talked about, has got some quirky stuff like gold in it.
Which is doing
My
very well
mate-
by all accounts.
Yeah, I'm not going to start showing out numbers because people are going to start coming around knocking on my door asking for where my gold is.
Buried in the garden. We've established that already, everyone.
I have had my fingers burned in the past by buying some active funds that have performed very well, and their past performance looked excellent. And actually, I bought into a UK small companies active fund at one point because I was kind of trying to second guess Brexit and all this kind of stuff and think actually it'll outperform, and it actually just didn't. It never did very well. And I eventually bit the bullet on it a little while ago and just kind of cut my losses, which was it's depressing, but sometimes you have to move on from it, basically. Thinking a bit more broadly, I don't think we're here today to solve the passive versus active debate. I don't think anybody will ever solve that because it'll always just keep moving on. I think what we want to do is get a bit of insight into how funds such as the Vanguard Lifestrategy series, how they work and what goes into making them. So I think Mohneet's going to explain that for us. We're also then
that would be
at,
really helpful, Ed. Sorry to cut across, but I do sometimes wonder is like, how are they structured? What decisions goes into this? You know, the thing about a passive that kind of recommends it a bit to me as well is it seems relatively simple. I can understand what's going on within it, whereas you add in all this other complexity. So yeah, I'm really looking forward to that. Sorry, cut across.
No. And then I think beyond that, we're going to look at a little bit, well, if you want to diversify out of these indices, then maybe look a little bit overweight in certain directions. What should we look for? What is the sign of a fund that isn't working for its manager rather than working for you? So let's not waste any time on it. Moni, to bring you back in then, just talk us through the life strategy funds a little bit, how they work, kind of what goes into them when you're managing them.
Yeah, so I think just before we go into life strategy, I just want to sort of come back on one of the points that Chris mentioned around the US tech stocks and sort of being kept up at night. And it's actually, in a way, all of this conversation around tech stocks concentration is actually a very healthy debate within the industry right now, I would say. It's really good that people are questioning it. But equally, when you look at data, or if you look at the other side of the argument, the fact that there's these handful of companies that are obviously, comprise quite a big percentage of the US equities index, what that's really doing is reflecting the dominance of these stocks, right? And that is essentially based on the valuation of those stocks, which is a result of the current earnings, and also potential earnings going forward of those names. Basically, how are those companies doing, the health of those companies like Nvidia, for example. But I do think that, if you just look at simple things, since we've had ChatGPT introduced, my question to listeners and to you guys actually would be, how quickly has ChatGPT been integrated into so many things that we do? I'm sure plenty of people listening, and it'd be good to hear if it's the same for you guys. But, so many people I know are using it a lot more regularly and a lot more efficiently and frequently already. And it hasn't even been that long since it sort of came out. So again, just goes to show if AI integrates fully into global economy, the tech dominance might well continue. And if someone is telling people that, I know the answer to this question, whether tech dominance will continue or won't continue, they're probably not telling you the truth because it's really hard to tell. The reality is that we just have to give it time, and we'll see over time whether this tech rally continues or not. So it's a really difficult sort of position that the market's in right now. And I'm not quite sure anyone has the answer to it. And obviously the only approach really, I would still say, is to just have the patience and just be invested. Just don't be in cash. That would be one thing I would say, because then you lose out on that sort of opportunity cost. Just coming back to your original question on life strategy funds. So when I was at Vanguard, one of the great things obviously about life strategy, and I was invested in it myself, one of the great things about life strategy is the sort of discipline, if you will. It's based off something Vanguard calls strategic asset allocation, which essentially means that you design the fund, you pick the funds that the multi-asset fund life strategy is investing in, and then you sort of stay invested in those over the long term, even if markets go up and down. That's a good thing, because if you're trying to sort of time when to sell something, when to buy something, it's really difficult to do it right consistently over time. So actually having that strategic asset allocation, I guess that what life strategy funds have, over the long term is extremely beneficial for the end investor because it just gives you that discipline that you need. In terms of picking the underlying funds that are in life strategy, it's essentially a market cap weighted fund, which is then adjusted for a home bias. That basically means that you have a slightly higher concentration to the UK stocks and UK bonds. And then once you adjust for that, Vanguard essentially picks the underlying funds for each of the geographical exposure. The good thing about the life strategy funds is that the way that Vanguard picks the building blocks of life strategy is very cost efficient. It's also very diversified, which means you have exposure to everything across the world. And they also, what I really liked about the life strategy funds is that they pick the underlying funds at Vanguard and they're all very cheap. So the overall cost to the end investor is actually very low, which is great. They're obviously quite competitively priced at 22 basis points, which make them an ideal choice, I would say, for someone who's looking to get started, who wants to be invested, doesn't want to sit on the sideline, but equally doesn't want to be out there picking the building blocks and the funds themselves.
Yeah, I mean, I think they're the kind of ultimate. And I remember in kind of past experiences when we used to do things like fund picks and that kind of thing, the first thing we would tell readers was if you're not confident about picking a fund here, then the life strategy series, and you can do 100% equity, you can do 80-20, you can kind of balance it with a bit more risk or a bit less risk depending on how much appetite you've got for it and what you're prepared to put at stake and how much time you've got to do it. So I think it can be, like you say, a really good option in that sense. Do you think, going back to that point around AI and some of the concentration, because one of the stats that also kind of caught my eye this morning was 80% of stock market gains in the US this year have been driven by AI related companies. This is driving the discussion in the media is, well, this just looks like another .com, boom and bust. All it's going to take is for one company to come out with a bad earnings report and it's going to send everything spiraling madly. The life strategy series, does it protect against that in some ways, or is it always just going to, by its nature, be exposed to an extent to that kind of issue?
Well, I guess if you think about, if you're invested in the market, there's always a risk, right? That's the nature of being invested. Markets go up, markets go down. I think investors who are investing in markets do need to be conscious of the fact that, investments don't just go up, they can come down as well. And that's the reality of it. But obviously, the good thing is that if you have the patience and the discipline, you see the rewards as you go along. And I think that's often a point that goes missed by many investors. So I think it's important to remember that. Obviously, something like the life strategy fund, the good thing is, because you do have the UK home bias, so there's like overweight to the UK. If US stocks is a concern point for you, and if it's something, in your words, as you mentioned earlier, is keeping you up at night, then that slight overweight to the UK is actually probably quite helpful, I would say. But also it's worth remembering that, there are so many other stocks that you're invested in. So even if you have 30-ish% in tech in the US, well, you still have 60-something% in all of these other industries, right? Which you will benefit from, because you don't know who the next winners are, who the next sort of Magnificent Seven or Fabulous Four or, whatever the market's calling them now are. They could be in any of that, that 60-ish% will have those winners in there. And what you really want to be doing is be exposed to that, because if you're not exposed to it, you're not going to benefit.
I think that's a really interesting point there as well. And one of the, I think, really underreported stories this year, actually, is that if you look at the FTSE 100, which is, we talk about the UK being unloved, the UK economy not doing well, the UK not having tech stocks, not enough IPOs. There's a lot of doom and gloom about what's going on in the UK. But if you look at the FTSE 100, I was just looking now, it's up nearly 14% year to date this year, which is extraordinary numbers for the FTSE. Amazing performance. And that speaks to, well, if you just disregard certain bits of the market, then you will just miss stuff out. So actually, you need to have a diversified approach that accounts for different areas, and it builds in potential, performance in the future in certain places that might not appear in others. So you've got to have that broad base.
So Ed, on that, sorry,
Chris, yeah.
just Moni, I don't know how close you were to this, but I'm really interested, as somebody who has looked to try and build diversification in through, regional differences, I suppose, across the globe. What's the process of picking the underlying companies within the fund? Because you mentioned diversification even within the life strategy thing itself. So you obviously have sort of mindful parameters that you use to pick those companies. Team of people that go out and find the next big thing, who the next speculators, who the next Mag 7 is or Big 4 will be? Or is it just a case of poring over earnings and thinking about sectors that have got a likely upside and picking the best ones in there? What does that look like? What does that process look like in terms of picking those underlying investments within these funds?
Yeah. So obviously within something like life strategy, the underlying building blocks are passive funds, right? So they are obviously tracking an index. So essentially what you're doing is matching what's in the index. And so you're not specifically going out and making an active bet.
Mm-hmm.
However, I can tell you from my experience previous to Vanguard, when I was at Nomura Asset Management and we were managing active bond portfolios, they were teams of analysts who would basically look through, whether it's on the fixed income side, so whether it's bonds or equities. There were analysts that were looking at earnings, that were looking at sort of, corporate earnings, whether it's for, again, corporate bonds or for equities. They were looking at earnings reports. There were, people who specialize, for example, if we take auto sectors, right? So there would be someone who's focused just on autos. So they'll be looking at BMW, Mercedes, all these car manufacturers. And their only sole job is to look at that sector. And they spend 10, 20, sometimes even longer in that particular sector. So they know anything and everything probably there is to know about a lot of these companies. And that's how they are sort of making a bet. If you look at equity analysts at any bank or asset management, really, and essentially what they're doing is looking at everything they know, all the data, all the earnings reports, and then they'll say, I think this looks like a buy, or I think this looks like a sell, or I think this looks like a hold. Essentially, that's how decisions are made. And then something like that would basically feed on to portfolio managers who would then say, okay, well, this is my whole portfolio looks, and I need an auto stock potentially. So this one looks good, so I'll put this one in. And I think this is the right time to buy it. So that's how decisions are made. But what that also tells you that if someone who's looking at a specific sector for almost 20 plus years and knows a company inside out, and sometimes even they get it wrong. Like if you look at tech analysts, right? I'm sure the way NVIDIA has performed has probably outdone many people's expectations. And I'd be surprised if all of those tech analysts actually called NVIDIA doing the way that it's done, which just goes to show if they find it difficult to do, what makes people like us think that we are in the right position to pick the next winner, right? It's what I'm trying to say is it's really difficult to do.
Yeah, so I think that is ultimately the biggest kind of selling point of mutual funds, of funds that take care of this for you, is that they have access to deep resources and they get to look inside these businesses in order to make judgments about whether they think it's a good investment or not. So I think that kind of brings me to the next bit of the podcast here, which is, okay, so we've decided that we don't necessarily just want to set our hat on purely passive. We want to look at some of these funds and where they might bring benefits. Are there guidelines that we can set when looking for them, rules of thumb that we can kind of live by when it comes to picking these funds? What is your experience of that, Mohneet?
I think first thing I would say is try not to overcomplicate it. Simplicity is good. Simplicity is the ultimate sophistication. I know there will be manufacturers and people who design products who will try and sell you a very complicated product. The reality is that if you take life strategy funds as an example, they're actually pretty simple for people to understand. And it's been designed that way. Vanguard's motto for life strategy was outwardly simple, inwardly sophisticated. And that's essentially what you want. You want it to be simple for people to understand, but obviously be sophisticated under the hood, not complex. The second thing I would say is try and just stay off fads and themes and, what's flashy and trendy right now, because look at ESG today and think about where it was 3, 4, 5 years ago. Again, perfect example, right? And then lastly, I would say when you think about what are the 3 big factors that really, define how well you're going to do at sort of creating wealth and preserving it over time. The first one is how often you save and how good you are about saving. So it's that saving habit, really important. Start as early as you can, save as much as you can. And then the second part is be patient with time. Invest it, but be patient. Don't be going in and out of the market, because that you're just eroding potential returns doing that. And then
One
the
of the
last one is,
Yeah, go on.
sorry, go ahead.
No, you go.
The last one I would say is keep your costs low, because the higher you pay for a product, the less you have that's compounding for you over time. Compounding is so important, right? You invest, you wait, you have the discipline, and over time, that investment and the returns will compound. And they get bigger. It's like a snowball effect, a snowball coming down the hill, right? It gets bigger and bigger and bigger. Compounding isn't some sort of magic, but the results definitely feel like it.
One of the Chris, I'm going to come to you now on this as well. One of the most interesting trends of the past few years, I think we've seen too, is the sort of the end of the superstar fund manager. If I think back probably 10 years ago now, there were names out there that were huge. They were active stock pickers, often quite concentrated portfolios with very specific, quite often sort of contrarian themes, should we call it. They seem to very much have struggled in recent years, and the story around those superstars seems to have gone a bit more sour. Chris, do you think there's too much of a focus? I mean, we've obviously changed, haven't we? The narrative has changed away from superstars.
I mean, mentioning a name here that's been prevalent in the UK, there's obviously been a lot of fallout around Neil Woodford's fund and what happened there. I think that's probably done a bit of damage to the Star Fund Manager brand overall. He was somebody who was pulling up trees left, right and centre. And then obviously, the equity income fund that he had basically collapsed, and a lot of people were burnt from that, and that created a lot of national headlines, rightly, by the way, in terms of I understand why that's a major story. A lot of people were burned within that. So there's a shift away from that. I think there's also this general, and this maybe is reflected in the stocks, and this is me just kind of extrapolating themes here. I'm no investment expert, but around focus on systems and the idea that tech, you don't need to be a staff fund manager to see that AI is going to be big, right? You just need to kind of pay attention to what's going on out there in the real world, as Mohneet mentioned, in terms of what people are using. So I think perhaps the narrative's a bit simpler, despite us living in a more complex world. Those things seem a bit clearer in terms of what might roll out more broadly. So again, do you need a staff fund manager to spot that? You probably do to spot the next trend, but while markets are kind of going up, often separate to what's going on Main Street, then you don't need that expertise, I suppose, in order to generate some returns. And then you add in the cost factor. There's a lot of information out there. You've got platforms that allow people to do it themselves a bit more. You've got a lot more democratization of information through conversations like we're having and things like that. And actually, perhaps the mystery that was tied up in some of these staff fund managers has been removed somewhat. I do think in the future, though, you'll see a comeback of some sort. And it might be in combination with systemic things like AI powering decision-making or gathering of data, as well as those teams of analysts that Mohneet mentioned. There might be some more of that sort of combination of the two coming back down the line where, big, strong personality sits on top of it, making sure everything works well, and someone with a good instinct, and then, great underlying systems that keep an eye on all the kind of things on the dashboard and make sure the fund's going in the right direction. So yeah, I think there's been a combination of things that mean more people have switched. And then also this active passive debate mixed in with cost probably for me has been very influential in that. So, maybe a bit skeptical of these success stories and more sort of thinking about that last point that you made, Mohneet, around you don't want the costs to impact the compounding, right? So I'd rather just try and make sure that I can get the upside whilst also making every penny count.
Mohneet, is there still value in seeing names on funds and thinking, okay, well, maybe that manager has been there for 10 years, he's got a good track record, or she's got a good track record, so we can set a bit of credibility alongside that? Is there still value in that?
Look, don't get me wrong, there are some great portfolio managers out there, but the problem is that you are risking it all on one person, right? It's a key person risk, essentially. Let's say if that person leaves, what happens if they're the ones that you're sort of betting on? The other problem, if you look at data, and for me, whenever there's any kind of confusion in my head, I always look at the numbers. And when you look at the numbers, a lot of research shows that actually passive outperforms active over time. And the main reason for that is that, picking winners consistently is really difficult. There are very few active funds that outperform over the long term. And the reason for that is because picking the next Mag 7 every single time, every few years, you might get it right once, twice, 3 times even. Probably not going to get it right 5, 6 times. And that's really the crux of the sort of passive argument, right? So even if you have a nice flashy name on paper, yeah, maybe it will help you for the next 4 or 5 years, but what's the guarantee it's going to help you for the next 10, 15 years? And it's going to outperform a nicely ready-made multi-asset fund that's ready for you to use. So it's not, unfortunately, it's not as simple as it sounds. I think, yeah, it's nice. The idea of it is nicer than the reality of it when you think about star flashy fund managers and active funds. And again, coming back to Chris's point, it's like every penny, you want to make sure every penny counts. And every penny sort of does the job, right? Because you can't have that beautiful compounding effect if you're paying so much in fees. The more you pay in fees, the less you have for it to sort of build up over time.
Yeah. So it's a real tightrope, isn't it? Because you've got on the one side this issue that we raised earlier where our passives unbalanced because of the nature of the markets at the moment. But then you've, on the other side of that, the alternative actives, you pick the wrong one and you miss out on the winning trend, so to speak. When it comes to looking at those broader areas, then setting aside passive and active, when you're looking at, okay, well, what regions look like they're going to do well? What sectors look like they're going to do well? Should I be thinking about something more defensive or something very geared towards growth? What are some of the what goes into your thinking on that when you're making choices?
Yeah, so one of the things I would say, I just want to use an example of a friend here actually, is someone who did like a PhD in biotech, and he was very sure that biotech is going to be the next big thing and it's going to outperform so many other companies. He invested in, let's just say his portfolio was very biotech heavy, and he's still waiting for that performance to show through. And this is someone who's got a PhD in the sector, so you would think that I'd be able to pick the right name, right? And he's struggled. Just to sort of give you some perspective on what it actually looks like in reality. Now, just coming back to your question, sorry, I just want to add one more point around passive and active. Even around this whole Mag 7 debate, quite honestly, it's not like market concentration has happened before. It's not the first time. And even then, over time, passives have outperformed, right? And there's always, markets move in cycles. So there'll always be one sector that dominates. In this case, it's tech. Yes, you could argue that the dominance is quite big right now, which is why I sort of go back to my earlier answer that this is a healthy debate. But I do still think that personally, I would say passives are a better way to go given everything that we know today.
Mm.
Honestly, my money, and even for my kids and their junior ISA, is in passive index trackers, all world equity. And the reason for that is, I can tell you because I've seen it on the inside, it is really difficult to even pick across sectors, because you can maybe call certain sectors and you can say, okay, this sector does well when there's a recession, or this sector doesn't do well when there's a recession. But even within that, you'll have companies which are winners versus companies that don't perform so well during a recession. So it's not as clear cut as saying this sector does well and this sector doesn't. So I'm going to be overweight here and underweight here. There's, many layers of complexity underneath, and that's the truth. I really would urge people to think about, again, diversification. Don't try and invest in one sector. Just try and be as diversified as you can, even if you're trying to pick stocks or sectors.
So I think that more or less brings us to conclusion on it. I'm very keen to hear from viewers and listeners what their thoughts are on if they have a process that they look at their fund, if they pick funds, whether they set and forget passives and just get on with their lives and don't check their portfolios. I know we've probably got more views we can share on it, but I think that sets up the debate quite nicely. Mohneet, thank you so much for joining us to chat through some of this. It's been very interesting getting some insight into how kind of the world of the passive fund side of things work. I'm sure we'll have you back on again to discuss more things going on out there in the world of investing, because it's never a dull moment, basically. So, Mohneet, with that, thank you.
Perfect. Thank you so much, guys. I hope it was useful. Thanks. It was lovely to chat.
And thank you, Chris, as ever, for your contributions.
My pleasure. My pleasure. It was useful and was interesting. Thank you, Mohneet.
Brilliant. Thanks, everybody. With that, I'm going to say goodbye. Thank you and goodbye.